these candlestick patterns work, but also how you can make them 100 times more effective. Now, a candlestick that's showing a hammer or an inverted hammer, like these two here, the reason why we are getting a reversal signal there is really quite simple. Let me zoom in on these just these two candles. Actually, I'll do 3 candles. Now, what we're seeing here is that on this candle, of course, the open is higher than the close. Pardon me. The open is lower than the close, so the bar is up. Same thing over here. Here's the open, here's the close. On this bar, here's the open, here's the close. So the market that day moved up. But the bar, in this case, let me put a line, but the bar here you can see is slightly down. The close of this second bar is lower than the close of the first, indicating a down bar. And of course, this third bar is quite obviously lower than both. Again, a second lower bar in a row. Let's talk about the mechanics of the candlestick pattern. At some point during this first bar, the market was moving down. Now remember, the market cannot move down unless selling is coming into the market. The market not only reversed the selling, but turned the selling into net buying because the price started to exceed the opening price. The same thing applies for the next bar. Selling came into the market, pushing it all the way down, until finally the market turned around, turning the overall net selling into net buying. Not quite enough to overcome the prior day's close, however. So the bar isn't considered up, but we can see that strength is coming into the market on a down bar. On the next bar. Now, this bar, we can see that the market did indeed push lower. Only this time, the market was not able to recover all the way past the opening price or the prior close, but it is significantly off the bottom. These different types of probes form up the inverted hammer, where you can see that the market is pushing lower and then coming back up. Where we need to be concerned, and how we can now make a comparison, is by simply looking at the volume. Is the volume, relatively speaking, high, or is the volume, relatively speaking, low? Remembering the greater context or the overall position of the market. In other words, you can see here that this particular market had been moving up already, so we're not talking about turning a trend, we're simply talking about activity as the market starts to move, which leads me into prior consolidation areas. Now, we're going to combine some different concepts here, and then I'll review and bring it all together. You can see that there's a prior consolidation area here. Now, this consolidation area forms a support area on the low and a resistance area on the high. Whether we draw it based on the actual high of the bar or the low of the bar at this point isn't important. All we need to do is understand that we're talking about a zone, high and low, where we have support and resistance. Now, what we want to look at is what is the volume based on that area. Now again, this is where you could quite easily get out your calculator and physically add it up. But here we can see that we've simply put a